Kraken just turned your stock portfolio into a margin trading machine, and somewhere in the data, a 43-month low in Bitcoin pain suggests someone's about to get very rich or very sorry. Tonight, we're watching a market that's finally separating signal from noise. Leverage is reshaping who owns what. Prediction markets are booming again, and the arithmetic of fear is starting to whisper that the floor might actually be here. Hey, welcome back to Finance Graph. Today, Kraken's Collateral gamble, stocks as crypto fuel, prediction markets prove the crowd can price uncertainty, the W pattern and the geometry of reversals, and the pain index, 43 months of losses compressed plus 2 more. Let's get into it. Let's start with something that felt impossible 3 years ago. Kraken announced eligible users can now pledge tokenized stocks and ETFs directly as collateral for futures and margin trading, all without liquidating a single share. You hold Apple, you borrow stablecoins against it on Kraken, and you're off to the races in leveraged crypto. This is a genuinely novel plumbing. The old friction is gone. Before this, if you wanted to margin Bitcoin, you had to sell your equity holdings, convert to fiat, wait for rails, and pray the window didn't close. Now you're tapping your stock portfolio in real time. What does this mean? It means leverage just got cheaper and faster for a whole class of traders who've been sitting on the sidelines holding both buckets of capital but couldn't easily marry them. Graph's take: this is the kind of boring, invisible infrastructure that moves mountains. It doesn't feel like news because it's not fancy, but it solves a real problem that's existed since tokenized stocks became legitimate assets. The question isn't whether traders will use it, it's how fast the feature bloats and what collateral haircuts Kraken needs to defend against. Watch how quickly this spreads to other exchanges. While equities and crypto traders were panicking in June, Kalshi set a record month for trading volume, fueled largely by FIFA World Cup betting. Now, before you dismiss this as mere sports gambling, notice what's actually happening here. Prediction markets work because they force real money into the mouth of uncertainty. You either believe an outcome or you don't, and you bet accordingly. When volumes spike, it means people are willing to stake capital on outcomes they think the conventional wisdom has mispriced. Kalshi's surge isn't just about soccer fans. It's a live gauge of market confidence and willingness to risk at the margins. The macro context matters. Bitcoin and Ethereum had just bounced off multi-year lows in late June as dip buyers finally showed up. That's the same moment when prediction market activity erupted. People don't speculate on the future when they think the present is doomed. Rising volume in uncertainty markets is a shadow indicator of risk appetite returning. If you ask this old coin, the fact that traders are paying to forecast outcomes across multiple domains at the same time, crypto, sports, politics, presumably coming next, suggests we're watching the early infrastructure of a much larger shift. Eventually, these markets mature and become price discovery mechanisms for everything from election odds to interest rate paths. We're maybe at the end of the first inning. John Bollinger, the man whose bands have bracketed volatility for 40 years, took a hard look at Bitcoin price action in early July and saw something geometrically meaningful, a W-shaped reversal pattern that, if it completes, could break the entire downtrend. Now, you've heard plenty about technical analysis from people who've never actually traded, so let's be precise. A W isn't magic, it's a two-dip pattern. First valley, bounce, second valley, bounce again. If the second bounce reaches above the first bounce, the pattern is confirmed and the prior downtrend is formally broken. Bollinger's observation wasn't a call to all in, it was recognition that the structure of price action had changed. Bitcoin had been in continuous weakness. Now it was oscillating in a way that suggested buyers were defending lows. That shift from capitulation to accumulation is what a W describes. The timing is interesting. This observation came precisely when spot Bitcoin ETFs saw a $221 million inflow in a single day. July 2nd. Institutional capital doesn't move on technical patterns alone, but it moves in concert with them when the broader macro backdrop shifts. Color me skeptical that any one indicator crowns a market bottom, but when structure, flows, and sentiment align, they're worth taking seriously. The W is a way of saying the market is showing its work. Bitwise's chief investment officer, Matt Hugin, looked at the Bitcoin profit and loss ratio and offered a blunt verdict. The bottom is closer than ever. That ratio hit a 43-month low in late June. What does that mean in English? It means the proportion of Bitcoin holders who are currently sitting on losses has compressed to a level we haven't seen since late 2021. Think about the geometry of that. In 2021, Bitcoin crashed from $69,000 down through $30,000. Nearly everyone who'd bought above $35,000 was underwater. Those people eventually capitulated, sold, and the market bottomed. Fast forward to 2026, and the same ratio is screaming at us that we're back in the pain zone. The difference is instruction. Back then, leverage was easy, retail was overconfident, and nobody was thinking about risk. This time, the pain is real, but it's distributed among people who've already lived through one or two cycles. A Swan Bitcoin analyst doubled down on the implication: if you believe the bottom is in, buying at these discounted levels beats paying higher prices later. That's not advice, but it's the logical endpoint of what the numbers are saying. If profit and loss ratios are at 43-month extremes, either they revert, which means prices rise, or they go even more extreme, which means more capitulation is coming. Those are the two scenarios the data is actually offering. Graph has spent enough cycles in this business to know that when pain gets this concentrated, it either breeds new buyers or it breeds total surrender. We're about to find out which. Solana network activity surged in late June, driven by a resurgence in Memecoin speculation and renewed prediction market interest, which coincided with a rally in Sol price itself. Now, Memecoin activity gets a lot of eye-rolling, and deservedly so, but it's worth understanding what it actually signals. Memecoin booms happen when three things align. 1. Capital finally feels safe enough to chase speculative outfits. 2. On-chain infrastructure is robust enough to support high-frequency, low-friction trading. And 3. Retail confidence is returning. All three were present in late June Solana. What makes this interesting isn't the memes themselves, it's the breadth. When speculation concentrates in a single ecosystem, Solana in this case, and when that concentration correlates with price strength, you're watching capital flow from defense back into offense. In May and early June, traders were huddled in Bitcoin and stablecoins. By late June, they were breathing enough to fork out into Sol and its ecosystem. That's a shift in risk appetite that shows up in Memecoin volume before it shows up anywhere else. Treat Solana's surge as a breadcrumb. When the most speculative, leverage-friendly, ecosystem-native assets start moving, the bottlenecks in the broader market are loosening. Whether that sustains depends entirely on whether macro conditions stabilize and whether the capital that's coming back is institutional dip buying or just retail adrenaline returning. The odds favor the former given the ETF inflows, but the memes remind us volatility hasn't gone anywhere. Revolut announced it will delist USDT after August 31st, converting remaining holdings into users' base currency automatically. This is the kind of news that bounces off the headlines but deserves a deeper look. Revolut isn't a marginal player, it's a major fiat on-ramp for European retail. The stated reason is regulatory and risk concern. Unpack that. Tether's reserve adequacy, its relationship with various regulators, and its operational transparency have been points of contention for years. Revolut is making a calculation that the reputational and operational cost of holding USDT as a primary stablecoin has finally exceeded the benefit. That's a regulatory signal disguised as a business decision. It doesn't mean USDT is about to collapse, but it does mean major institutions are now de-risking their exposure to it in ways they weren't 12 months ago. The second order effect is customer pain. If you held USDT on Revolut, you don't get a choice. You get converted. That forces people into liquidity events they didn't plan for, which creates micro-level friction in the ecosystem. But the macro signal is cleaner. Stablecoin fragmentation is accelerating. USDC, USDT, and increasingly domestic or regional alternatives are competing for rails, and regulatory concerns are now explicitly moving capital. If you ask this old coin, this is what financial infrastructure maturation looks like. It's messy, it's not bullish for any single stablecoin, but it's healthy for the ecosystem as a whole. That's the market as of early July. Leverage is getting cheaper, prediction markets are picking up, and the people who got it right in the prior cycle are now back in the markets buying cheap. If you want to track when institutions start piling in rather than nibbling, keep watching those ETF flows. They'll tell you when consensus shifts from lower prices are coming to the bottom is in. Subscribe to Finance Graph if you haven't already, and come back tomorrow night when we'll be watching what happens if the $221 million inflow from July 2nd turns into a pattern rather than a one-off. Until then, stay skeptical and count your coins. This is educational and entertainment content, not financial advice. Never invest more than you can afford to lose, and always conduct your own research before engaging with any asset or strategy discussed.